Did you know that the U.S. Department of Treasury estimates the ultra-wealthy in America are missing out on paying over $160 billion in taxes every year? That number is hard to wrap your head around. So, how do they manage to get away with this? For most of us, taxes come out of our paychecks. We do our jobs, earn our money, and send a portion back to support government services and programs. The rest goes to everyday expenses like groceries, bills, and maybe even some concert tickets. But for the ultra-wealthy, they don't rely on regular paychecks. Instead, they build their wealth through investments, and they usually only pay taxes when they sell those investments. Of course, some find creative ways to avoid taxes altogether. One common tactic is to hide their money in places like secret Swiss bank accounts or shell companies in the Cayman Islands. It might sound like something straight out of a heist movie, but many wealthy individuals use these foreign accounts to keep their money away from the IRS. These tax havens can be appealing to those looking to stash their cash without alerting the U.S. government. First, a wealthy person or maybe their financial advisor will find a country that collects low or no taxes on foreign funds stored there. However, foreign banks are still supposed to report to the U.S. on foreign accounts held by individual U.S. citizens. Instead of putting an account in their own name, a rich person could form a fake company that doesn't really do anything and open accounts in that company's name. Popular tax haven countries like Panama and Luxembourg will look the other way, while these anonymous company owners move money in and out of their accounts without reporting it to the IRS. But as you may know, this is pretty illegal. U.S. law requires that citizens report all of their assets, even if they're stored abroad. So if the IRS catches you keeping secret foreign investments, you could get in pretty big trouble. Lucky for the rich, there are totally legal tax havens right here in the U.S. In addition to the taxes we pay to the federal government, the states and even cities we live in can collect taxes too. So a state might collect income taxes on the money we earn, capital gains taxes on the money we make from investments, sales taxes on things we buy, and property taxes on the value of our homes. However, all states have decided to mix this a little differently. Some states, like Washington, don't collect an income tax at all. And that's why billionaires like Bill Gates and Jeff Bezos have lived there for decades, and 8 states, including Nevada, Texas, and Florida, don't tax capital gains either. Wealthy people who want to pay the least amount of taxes may choose to live in a state that doesn't tax their income and investments. In 2021, Washington State passed a law that allowed them to collect capital gains tax for the first time. Now, anyone who makes more than $250,000 selling investments would owe the state 7% of anything they earn after that first $250K. So what did Jeff Bezos, who makes billions a year selling Amazon stock, do? He moved to Florida, where he'll keep $610 million in his pocket this year by avoiding Washington's tax on his investment gains. And there's another strategy that wealthy people use called buy, borrow, die. Remember that we don't get taxed on our investments as they grow. It's only when we sell them that we get taxed, and that's why the ultra-wealthy just don't sell. Instead, when they need to buy a new spaceship, they can take out loans using their investments as collateral. Back in 2020, when we knew Elon Musk held $548 million in personal loans. That's the money he actually used to pay for utility bills, shop for groceries, or most likely pay other people to do those things for him, while the rest of his wealth was tied up in Tesla stock. He did this again in 2022, securing $13 billion in loans that he used to buy Twitter. But because these billions are in loans, not income, Musk and other super-rich investors don't have to pay taxes on that cash. So the rich buy investments and let them grow, then borrow against those investments to fund their lifestyles. But what's the die part? If you buy stock for $10, hold on to it for decades until it grows to be worth $1,000, and then die without ever selling it, whoever you choose to inherit your estate can sell that investment. But thanks to a tax rule called the step-up in basis, your heir doesn't owe taxes on the full $990 that your investments grew while you were alive. Instead, $1,000 becomes the new starting value. And if your heir later sells the stock for $1,200, she only pays taxes on the $200 it grew after you died. By using the buy, borrow, die strategy, nobody has to pay taxes on all the capital gains that happen during your lifetime at all, which is how some of the wealthiest people in the country manage to amass billions while barely paying taxes on any of it. But sometimes the rich do need to turn their mega investments into cash. They have some creative ways to hide that money too. Whenever they make money selling an investment that grew, the rich might also look for losses. That might mean selling off investments that are losing money at the same time. Any money you lose gets subtracted from what you gain, and you only pay taxes on what is left over. If you have a lot of losses in one year, you can even wait to count those losses against income you have in the future. This strategy, called tax loss harvesting, helps rich people sell their investments at a profit while making it look like they didn't really walk away with much. Wealthy people can also find losses by structuring their fancy hobbies as businesses, whether it's training racehorses, owning a sports team, developing luxury real estate, or buying a social media platform. The ultra-wealthy can afford to start or buy businesses that they don't actually expect to live off of. So when those businesses lose money, it can actually be a good thing. In the 1980s and 90s, when Donald Trump was just a wealthy real estate developer, he reported over $1 billion of losses from his hotels, casinos, and apartment buildings in a single decade. His tax returns dating back to 1985 showed that those business losses got subtracted from his income and investment gains, lowering the total he had to pay taxes on, sometimes to zero. ProPublica found that between 2014 and 2018, the 25 richest Americans paid only 3.4% in taxes on their total wealth increase. Meanwhile, the median American household pays about 14% of their total income. While this may seem crazy, strategies like buy, borrow, die, and tax loss harvesting are perfectly legal ways to hide your wealth. There have been attempts to close some of these tax loopholes. In 2022, President Biden proposed that Americans with over $100 million in wealth would have to pay a 20% tax on their investment growth, even before those investments are sold. Senators like Bernie Sanders and Elizabeth Warren introduced a bill in 2021 that would have eliminated the step-basis rule that allows people to inherit a lifetime of gains tax-free. Still, none of these plans have been enacted into law. Legislators are still debating how to close these tax loopholes, but the ultra-wealthy don't seem too worried because the longer it takes us to figure it out, the more their hidden wealth continues to grow. That should be it for today, and if you found this information valuable and want to learn more, please like this video and subscribe to my channel for more insights.